let's get started. Thanks again, everyone, for joining. My name is Kimi Rasmussen. I'm the head of reserve at Stashaway. Today, I have Corinne from Hamilton Lane with me, and we're going to be talking about private credit. We will leave about 10-15 minutes for Q&A at the end of the webinar. So if you have any questions, please pop them in the Q&A box at the bottom, and we will get to your questions at the end. Before I hand over to Corinne, who is no doubt the expert on private credits, I'm just going to take you through a little bit of disclaimers, and then I'll talk a little bit about Stashaway, private market offering, and SRS more broadly. Okay, let's get started. So first things first, a little disclaimer, just to let you know that what we'll be talking about today is intended for educational purposes only. So speak to a financial advisor, tax advisor, or if you have a wealth advisor already because you're an accredited investor with Stashaway, then reach out to them to talk more about this topic. Secondly, this is actually not a webinar specifically for accredited investors. So we will be sharing lots of educational content around private credit. But what we can't share, because we do have non-accredited investors on this webinar, is all the details about our private credit portfolio specifically. So you'll no doubt have some questions around the minimums, the fees, the returns, and so forth, which unfortunately we won't be able to help you with today. But I will be sharing the contact details of myself and my team. So you reach out to us after the webinar in the coming days, and we're happy to answer your questions as long as you are a verified accredited investor with us. And that is because private credit, private markets is only intended for accredited investors. So just to start, as you probably, as you might or might not know, with Stashaway, you do have access to a full suite of products and services to meet your needs. So we offer everything from cash management, and that's both USD and SGD, to our core portfolios, which is our general investing portfolios, our thematics, and then also alternatives, which we've been offering for quite a few years now. And today, we will specifically be discussing private credit, which is a semi-liquid portfolio. So first, why allocate any of your money to private markets? Well, firstly, to enhance your returns. So private markets can really help you improve the risk and return profile of your portfolio, which helps you overall lower the volatility and enhance your returns. Separately, you will also see lower volatility in private markets, as they also have a lot lower correlation to public markets. So again, adding private markets to your portfolio can help reduce the overall risk and volatility of your portfolio. And then again, we always talk about diversification here at Stashaway, and adding private markets to your portfolio will, of course, broaden the diversification of your portfolio. Again, I will let Corinne go into the details. She is the expert. But what we do offer at Stashaway in the private market side of things is really to make it simple, cost effective, as with everything else we do. So majority of our private market offering is managed by Hamilton Lane. So our funds are managed by Hamilton Lane. These are semi-liquid, so you can subscribe monthly and redeem monthly, and then they come with low minimum investments. And why are we talking about SRS? Well, we're actually in the coming days launching SRS funding for private credit. Private credit has been very, very, very popular with our clients, with our accredited investors. And if you are not already setting aside money in the supplementary retirement scheme, you might be considering it. But a lot of our clients do, and they've specifically requested for SRS funded private credit portfolios, because again, SRS is for the long term. It's your retirement saving, and so they they've been asking us to come up with this. So in the coming days, you will see the ability to fund your private credit portfolio with your SRS. For those who might not be fully aware of what SRS is, it's a supplementary retirement scheme, which means that you are voluntarily contributing. So as long as you're a tax resident in Singapore, you are eligible. There's just a small difference in that Singapore citizens and PRs, the contributions there are capped at 15,300 per year. For foreigners, that's slightly different. It's higher. Contributions are annually capped at 35,700. And what's the advantage? Of course, you're saving for your retirement, but on top of that, by actually setting this money aside voluntarily on an annual basis, you also get tax benefits. So contributions to SRS are tax deductible. And for Singaporeans and PRs, you can then start withdrawing from your SRS funds at statutory retirement age. For foreigners, that is after you've been saving up for 10 years. So the funds need to stay there for 10 years and then you can withdraw. And then withdrawals are given a 50% tax concession. Now, when you start putting SRS aside in your bank account, there are 5 banks you can open an SRS account with. That account only yields 0.05% per annum, which is not a great deal. It's definitely not going to keep up with inflation. So what you can do and what you should do is maximize your SRS growth through investments. And so Stashaway is one of the few platforms where you can, for example, invest in ETFs with your SRS. And also very soon in private credit. And just to show you the difference, if you leave your money, your SRS funds, just in the SRS account, earning 0.05% per annum over 20 plus year period, you're not really going to make much out of that. Again, it won't be keeping up with inflation for sure. Whereas if you, let's say for the first 20 years, optimize for an 8% return per annum, you're looking at a much, much, much higher return. Some will then lower potentially the risk as they get closer to retirement age and go to a 4% return per annum. But as you can see, the difference is quite significant. Now, if you want to discuss private credit, SRS, and we can do some calculations with you on is it worth you putting money aside for SRS? It typically is. Then we can help you with all of that. So you can scan the QR code or take a screenshot or picture of our contact details here. So this is my team, Janelle, Vincent, and myself, and we'll be happy to help you and guide you. Okay, now I would like to introduce our speaker for today, which is Corinne Ko. She's a managing director based in Singapore for Hamilton Lane. Corinne, over to you.
Great. Thank you, everyone. And so glad to be here today talking about my favorite topic on private credit. In my mind, it's always a good time to talk about private credit, but particularly at this point in time, clearly because there's a lot more interest in the asset class. It's now available on SRS as a Singaporean. I think that's quite exciting. But also there's been some headlines on private credit recently, and also a recent rate cut from US Federal Reserves. So today we're going to talk about a few topics that we'll cover in today's session, which is what is private credit? Just a quick recap for those who are less familiar. Second, what are the recent updates? I just mentioned some of the macro updates in the recent times. And lastly, is private credit still an attractive asset class to consider given what I've just mentioned? And already I could see that some of our audience members cannot wait to hear that part, given there's already a question in the Q&A box which addresses exactly this. So just let me share my screen here. Checking that you can see my screen, Kimmy?
Yes, I can. Perfect.
Okay, great. So before I start today's session, maybe just to share a little bit about Hamilton Lane. So Hamilton Lane today is one of the largest private markets managers in the world. We have been investing in private markets for about 34 years. And today we manage around close to $1 trillion in assets under management and supervision, and 100% of this in the private markets. Um, and just specifically to private credit, we have been investing into the private credit asset class for 20 plus years. And today have more than $75 billion just in private credit alone. And importantly, I know that a lot of our investors, including some of the audience members today, are thinking about investing into private credit or are already invested in private credit through what we call the evergreen funds. So at Hamilton Lane, we were one of the early providers or early managers of private markets portfolio through open-ended evergreen funds for more than the past 6 years. So this is across a variety of different asset classes, across private equity, private credit, private infrastructure. These are largely available at Stashaway, although today we are talking specifically about private credit. So altogether today we have more than 13 billion US dollars in assets just in the Evergreen platform today. So let's talk about the private credit market opportunity and why is private credit growing so rapidly. So I'll say that typically speaking, a company as it seeks to get financing, particularly for its M&A needs, in the past it will usually go to a bank, and if the loan was relatively small, perhaps the bank would just give the loan to the borrower. However, if the loan was larger, usually what will happen is that the bank would then underwrite that particular loan. It will keep a small piece for itself. It will turn around and syndicate out the rest of the loan to a group of other lenders, much like itself. Sometimes it's tens of those, sometimes it's up to 100 of those. So that will call bank syndicated lending. I would say that in recent times, you can see here that especially in the past 10 to 15 years, what has happened is that there are more and more borrowers that have chosen to go and interact and directly engage with the end lenders. So that is what we call private credit. So between private credit and bank syndicated loans, or what I call the BSL market, you can see that here is the past 6, 7 years of data. And today, actually, with that trend, private credit actually speaks for a larger percentage of the lending to such companies versus actually the bank syndicated loans. And you can see that even the past 3 to 4 years, the percentage of private credit financing versus bank syndicated lending market, this has actually increased to more than 80% in many cases. So why will a company actually go directly to the lender versus going through a bank syndication process? There are a few reasons why this is the case. First and foremost is that usually for private credit, it's usually a small group of lenders coming together, 2 or 3 or 4 lenders coming together, working together to provide the borrower with a lending package. So usually it is actually much more easier for them to work together and shorter and faster for them to provide that loan to the borrower, and versus trying to bring together maybe 100 different lenders to come to a same set of terms. So therefore, it's more collaborative. It also brings greater speed of execution to a particular borrower when they needed the financing. Thirdly, it's also the certainty. So the public leverage loan market or the bank syndicated loan markets has been known to shut down or stop or pause the lending activity when there are periods of higher market volatility. And why is that the case? I think it's generally the sentiments does not allow them to be as smooth in the syndication process, whereas the source of capital from private credit is usually very stable and certain. And as a result, even through times of volatility, usually the private credit capital is there with great certainty for borrowers. So as a result, borrowers have grown to rely on and to trust this source of funding as well. And fourthly, it's actually more customizable. So not every company was built to be the same and the financing needs was the same. But I would say that in the private credit market, this customization is easily able to be taken into account versus when you're trying to build up a loan term sheet that fits 100 different lenders. And last but not least, when you're trying to take on financing or to take a loan, the last thing you want is that all your competitors know about your financial information and other sensitive market data. So when you have a more controlled group, a smaller group of lenders, the confidentiality aspect is definitely a very valuable attribute as well. So therefore, borrowers have used more and more of the private credit market in order to get their lending needs. So, how about from the investors' point of view? Why have investors started to embrace private credit as an asset class? Here, I think is a structure of the typical private credit loan that is on the performing end. So some of us may have heard of like distressed debt or special situations debt. Those are uh, non-performing debt. So that's what we set aside, but we call it performing debt that is being serviced, is being the usual borrower lender relationship. So this is usually in the form of a unitranche or a first lien debt or a second lien debt, which is on top of the capital structure of equity. So first and foremost, obviously, investors like the fact that they are sitting at the top of the capital structure, a little bit more so if they are focused on the first lien debt. So which means that if there was ever any case of a downside scenario or bankruptcy, that process, they are sitting at the top of the capital structure and are usually paid back first. Here you can see that usually the loan is less than 50% of a company's total uh, debt plus equity, which means that you're actually protected from the decrease in valuation of the company. So the company needs to decline in value by more than 50% before a single dollar is lost for debt holders. So that is very attractive, and even more so if you look at first lien, because you have to go through the company's value has to decline by 60 to 70% before a first dollar of first lien credit or first lien debt is actually impaired. Secondly, private credit has more attractive return than the average leverage loan or a bank syndicated loan, usually about 1 to 4% pickup over the public market equivalent. And why is that so? Obviously, due to the very attractive characteristic that I just mentioned in the prior slide. So private credit lenders are usually able to extract a higher level of spread or total return from the borrowers because of the attractive characteristic they're bringing to them as well. And and last but not least, just mentioned that private credit is usually held by a smaller group of lenders. So in a downside scenario, or if a company's credit start to show some signs of weakness, usually it is faster for a smaller group of lenders to respond and react to such a situation and try to support the borrowing company by helping them to look at their loans and structure it. So usually for private credit, there's lower default rate than public loans market, and also a higher recovery rate. That means you actually get back more on a dollar through private credit as well. So these are some of the few reasons why investors also gravitate towards the private credit market. So we're talking about returns. So I think this is a good chart to show because it shows a very long period of time, more than 20 years of data, with private credit returns being in the dark blue bars and the leverage loan index, Credit Suisse leverage loan index in the orange dots. So here you can see that over even long periods of time, private credit has actually very consistently and steadily outperformed the leverage loan markets. More importantly, I think for every debt investor, what they want to have is a peace of mind in their investment. So here you can see that across the same range of time, so more than 20 plus years of data, you can see here that in up markets, which is up market in the public equity market and down market, the average returns for private credit tends to be pretty similar, and the light blue and dark blue bars show the range of outcomes or range of returns. It also tends to be very narrow versus other private asset classes like private equity, venture capital, or real estate. So these are very interesting and attractive characteristics of private credit performance over the longer term. And this is a chart I think that I've seen Stashaway team shared before as well. So I think it's really about the downside protective characteristic of private credit. So over the past 30 years of data, I would say the worst five rolling years of annualized performance of private credit is still a positive number. It's a lower number, but it's still a positive number comparatively to a high yield index or a leverage loan index. So again, it is meant to be a downside protective type of investment asset class. So let's talk about the current market environment because we have talked about every things that are in the news, such as tariff uncertainty, rate cuts. We're talking about potential recession. Some are talking about market slowdown, even as we have a bull market on the public equities market. So let's tackle some of these issues and topics, including our Q&A topic in the Q&A box as well. So the first one I would like to address is actually the rate cuts. So just a few days ago, the Federal Reserve has cut rates by a second time in 2025 to bring a total rate cut of this year to 0.5%. So to take a step back, the total returns on private credit is consisting of two components. First is a base rate, which is measured by the SOFR rate, a secure overnight financing rate, plus a spread. So I would say that typically the spread for private credit has stayed relatively consistent through this market environment and stands at about 4 to 5% above the SOFR rate. And today the SOFR rate is about 4%. So at today's juncture, so here is today, we are standing at about 8 to 9% returns just from an unlevered private credit returns. So if you look at the past of private credit returns on an all-in yield basis, today we are sitting at what is considerably more attractive um, returns as compared to the past. Obviously, this is not the peak of total yield on an unlevered basis, but again, compared to the past, it's still relatively attractive. Do we see that there's actually more rate cuts in the horizon? So yes, we do see that there is a potential for more rate cuts, although the Fed notes were saying that there was actually much more uncertainty. The data was very mixed. It was very hard to make a decision. So we do believe that there could be more rate cuts in the horizon. But nevertheless, we see that it's going to be at a much slower pace. We don't see a case for rapid rate cuts, given that inflation is still high, and we do expect that there could even be some cuts and then followed by rate hikes again, given that we are starting to see the impact of tariffs kicking in and actually elevating inflation rate. So all in all, as we try to project what should be the returns of private credit going forward, we can still see that we have been projecting that over a credit cycle, returns should be in the high single digit range between 8 to 10% per annum. And we continue to see that in the next even 3 to 5 years, we should still continue to see that total returns remain within that range as well. And not to mention that for investors or for funds or structures or strategy that are able to access some modest level of leverage, you can actually see that there's a potential to be slightly above this line, given that this is an unlevered range of returns as well. Now, let's talk about the returns and the fact that we do see elevated or higher for longer scenario. What about the default rate? Do we expect default rate to start to tick up as well? Here you can see that we use the leverage loan default rate as a proxy. And I think I just mentioned earlier that we actually see slightly lower default rate in private credit compared to leverage loans, but the leverage loan market gives us a benchmark of where default rate is. So the orange bar being the long-term average, we still see that our current levels of default rate are still below the long-term average, and we see that it's actually relatively benign and low. Um, so that brings me to the very headline grabbing topic, right? Because for some of us who have been reading Financial Times, Bloomberg, and other financial news, you have seen that, you say that the default rate is expected to remain low, but we have seen some bankruptcy, which is attributed to private credit in the news, which are attributed to two specific companies. First Brands, which is a auto parts distributor, and Tricolor, which is actually a lender of auto loans to subprime kind of borrowers. So in this case, both of these companies have gone bankrupt, and um, I think one of the, and I say that no, private credit is not even cockroaches, because Jamie Dimon, who is the CEO of JP Morgan, has said that these headlines really means that it's like a cockroach scenario. If you've seen one or two cockroaches, most likely there's a whole bunch of cockroaches in your cabinet or in your drawer. Um, However, um, I think investors need to be a little bit discerning about what caused these bankruptcies. There, in both cases, these were actually cases where some of the collateral were double collateralized, and in the case of First Brands, there was actually some fraud involved as well. More importantly, both cases were actually bank syndicated loans, and they were not, in a pure sense, private credit. These would not have been loans that we would have made a private credit loan to. And to us, this really shows that because banks typically underwrite to lend, and they keep a small piece for themselves and syndicate out to a bunch of other lenders, they typically don't do a very deep underwriting because their interests are also not terribly aligned in this case. But in private credit, the small group of lenders that underwrite the loan, they keep the two or three lenders, they keep this loan on their books and invested throughout the life of the loan. So there's definitely much more alignment, and we do a much deeper assessment or due diligence of the loan. But to give an example, for example, we did see the First Brands deal in the syndicated loans market. It was shown to us by some of the brokers out there, and at that time, we saw a few issues with that. Firstly, I think there was some issues on the tariff case, where there was some tariff risk involved in First Brands. So in fact, I think one of the major supplier had issue of tariff evasion. There was also some EBITDA adjustments, which we felt very uncomfortable with. It seems to raise some questions about the quality of the earnings. There was also some governance issues there as well, because the company had undergone some very aggressive M&A that was pursued with debt financing as well. So I would say that if we were to hold that kind of like first brands kind of loan in the underwriting of private credit, it would definitely have not passed the underwriting. So that again shows that we need to differentiate between what is bank syndicated loans market and private credit underwriting, which tends to be much more robust. So as we talk about some of these topics in private credit lending, we some of our audience here might also have heard of paid in kind loans or deferred payment loans as well. So what happened in paid in kind loans, which have become more common in private credit, is that a typical loan will have in the borrower repaying the loan on a monthly or quarterly basis, and at the end of the loan tenure can be 3 or 5 years, they return the principal. But in a paid in kind loan, essentially the borrower does not repay in cash on the monthly or quarterly cadence, but they repay in units of the loan. Essentially, at the end of the loan tenure, they pay back all the interest payment in one shot and also the principal. So basically deferring all the repayments to the end. Essentially, we try to avoid the paid in kind loans, even though they usually offer a higher yield, given that we prefer to get cash pay and cash pay regular payments allow us to reduce the risk of the loan until the final repayment date. But again, we also want to share that there is if we see there's also good peak and bad peak. If we do see that in the market there's elevated use of peak, especially if borrowers are using debt because they are running out of cash to service existing debt and they are using it on a more structural, permanent basis, then we actually regard that as actually a bad peak. We'll stay away from those at all costs. There may be some cases of a peak which were negotiated right at the beginning as a form of flexibility for the borrower to do it on a very temporary basis if they were trying to pursue certain growth strategies. But this should be negotiated upfront with the lender as well. But all in all, firstly, I think we try to avoid having paid in kind loans in what we select. But again, definitely try to avoid the bad variety of this, the bad pick as well. So that brings me to the question. I think given the market environment remains uncertain, there seems to be more uncertainty in the market every time we look into the news or into the news flow. So in this environment, how can we ensure that our private credit portfolio remains robust? So here I show this chart, which is very important. I think firstly is very careful investment selection. So at Hamilton Lane, and we source for a lot of transactions, but we invest in only 12% of the loan. So we this means that we turn away more than 80% of the deals. I think that's very important that investors are highly, highly selective. Secondly, there needs to be a very rigorous phase of screening, due diligence, full due diligence, ongoing credit monitoring. I think that's very important to have a rigorous investment process. Thirdly, we are looking for some very specific characteristics of companies that we are lending to. Firstly, they need to be more service-oriented companies with high recurring revenue. They need to have, secondly, strong predicted free cash flow generation. Thirdly, more recession resilient sectors such as healthcare, cybersecurity, etc., and are mission critical. And lastly, we are looking for companies that have a low global supply chain dependence. So I mentioned that companies such as First Brands would not have passed this smell test actually on almost all these categories there as well. And last but not least, as I mentioned, we generally try to avoid pay in kind loans as well. So what does this bring us to in terms of trying to put together a robust private credit portfolio, especially a senior credit portfolio? Generally, we will try to focus the portfolio on senior secured loans, especially our first lien senior secured, because we just mentioned that first lien loans are even higher in the capital structure compared to just a broad general senior loans. Second, we try to target a low loan to value. At 40% means that the loan size is only 40% of the enterprise value, and the company valuation has to fall by 60% before a single dollar is impaired. So the lower the better. In this case, I think at 40% is extremely conservative. And last but not least, diversification is definitely a friend when you're trying to construct a good private credit portfolio. In this case, we'll recommend more than 200 issuers in the portfolio so that for any particular stress or scenario or any single deal or single debt would not significantly impact the value of the portfolio as well. So I think in summary, I've covered quite a few areas, but I created the abbreviation CRED for credit right here. I think firstly, we don't think that private credit is are cockroaches. There's no cockroaches there. We think that private credit underwriting is usually much more thorough and much more robust than compared to broadly syndicated loans or the public leverage loan market. So, important differentiation here. R is for resilience. So we have shown through our data that private credit has been more resilient, especially on down markets through history. And thirdly, um, elevated rates for longer, albeit that we are starting to see a rate cut cycle kick into place. We do expect that because of some of the macro factors, we will see rates to be higher for longer, especially compared to history. So this means that the total returns that we're expecting from private credit remains to be quite attractive. And last but not least, D for discipline. Cannot overstress how important it is for credit investors to remain disciplined. And this means not trying to overreach for a incrementally higher yield by giving up a lot more in quality. So trying to stay disciplined through a rigorous investment process, being selective, and having a lower selection rate. I think these are very important as well. So with that, maybe I can take a pause and see if there were any questions online.
Thank you so much, Corinne. That was great, and especially touching on the latest headlines from Jamie Dimon as well. So there are a couple of questions. So you already went through the rate cuts and what is to be expected from private credit given the rates are coming down slowly. But there's another question here. Are loans collateralized? If yes, what kind of collaterals?
Yeah, I think when we mentioned like senior secured credit, this obviously means that all of these are secured. So there are collateral. The collateral can be a range. Usually it is collateral that is suitable or that is fitting or in line with that company's business model. So usually it can be free cash flow. So having the ability to ring fence the cash flow as it comes in, being able to access the bank accounts, making sure there's no leakage. It can be PPE, it can be hard assets as well. So it depends on the business model. It usually because we stay away from hard assets, where we mentioned we are more focused on service orientated models with high recurring revenues. There's a larger percentage of our portfolio which will be focused on having secured by free cash flow.
Thank you. And maybe we can touch on the difference between, senior secured and asset-backed loans.
Right. I think so senior secured. So there's two different type of private credit, right? Or at least two. So in this case, what we've been talking about is actually corporate lending. So lending to companies, and the company is the obligor, or the borrower. And at the end of the day, the company is going to repay, is going to use this capital for expansion needs. Maybe it's actually going to build a new plant. Maybe it's going to hire a new office. It depends, right? So the at the end, you're trying to finance the activities of this particular company, whichever the needs of it is. So we call it private direct lending, or company lending, or corporate lending. The other type of lending that investors might have been exposed to is asset-backed. And in that case, it may not have a company that you're actually lending to. In fact, you're actually maybe financing a particular asset. The asset could be student loans, right? So you are actually financing into a bunch of loans. So in the case of a bankruptcy, you get back a bunch of loans, right? You have to actually foreclose those loans. In some cases, they're aviation, so you end up the asset is actually airplane or airplane parts, or it can be various type of different assets like real estate debt. I think it's a kind of asset backed, or even cell tower, right, in the case of infrastructure debt. So I would say that uh, it's intrinsically quite different, because in all kinds of corporate lending, it's actually pretty similar in terms of a bankruptcy code or a bankruptcy process. But in the case of asset backed, depends on what's the underlying asset. The dynamics of the debt actually can be quite different. And also, when things go south, the process of actually foreclosure and bankruptcy can be quite different as well. So in this case, this presentation is actually more focused on the corporate lending side.
Thank you so much. Okay, there was a follow-up question to the question on collateral. So how can the collaterals be double collateralized? Wasn't in-depth DD being conducted prior to loan disbursement? So assuming we're talking about
Yeah, I mean,
transparency.
again, we weren't involved in any way or
Yeah.
shape or form in that lending. So I think in that case, actually was a bank syndication. So yes, of course, in every case, you should make sure that something is caveated. If you have a first lien, you are holding the first lien. You're not holding the 10th lien, right? Hypothetically the same asset. In that case, given that there's double collateralization, it will be definitely a case of fraud. And in the case of First Brands, the truth actually came to light when the one lender say, "Oh, actually, there seems to be some issues. Maybe we should ask for a third party due diligence report." And then it was uncovered that that there was a case of a very weak asset, and some fraud involved. But I would argue that in that case, there's really a bit of a lax standard in terms of the underwriting, because they should ask for the third party due diligence report even earlier as well.
Yeah, it's interesting because I guess most people would assume, I think people who are not super familiar with private credit would assume that underwriting or due diligence um, should be better from a bank. So I think it's been surprising for many to see.
Oh, yeah, I think it's di different, because I think when you have a lot of volume, right, you're actually creating a lot of volume, a lot of transactions, and everyone is receiving sort of very standard type of package, right? Um, so everyone assumes that everyone is actually doing their work, but at the end of the day, you're only holding a 5% of the loan, maybe a 10% of loan. You're really not having a major skin in the game as well. So you're trying to create a portfolio of loans, right? And therefore you're not paying as much attention. But for private credit lenders, everything is kind of on the line, right? Because you're making a larger loan, it stays on the books. You actually cannot we hold it to maturity, essentially. We're not actually selling on the syndicated leverage loan markets, for example. So the alignment, I think, is much more tighter there as well.
Thank you. All right, we have another question, and everyone, please feel free. We have quite a bit of time for questions. We like to leave good time for questions, so you can ask away. It's always a good opportunity when we have Corinne or anyone from Hamilton Lane to kind of ask the experts. So another question here, Corinne, in the credit IRR versus PME chart, why is there no data for 2023 to 2025? Can you give an indication of how has the credit IRR numbers been doing or for 2023 to 2025?
Oh, okay, yeah. I think in that, yeah, I know which chart you are referring to. Let me just, yep. Maybe I think the audience is actually asking about this particular question because
Yes,
it stops at 2022.
two. Yeah,
Um, yeah, I think there's actually more updated data and it's actually broadly in line with this. I think it's just a matter of this particular IRR data. IRR data generally on a very young vintages tend to not make a lot of sense at the beginning just because they are IRR data, but usually on the third year almost it makes sense. So we are now in year 2025, so that's why the look back window that we're presenting is year 2022. But I expect that it's actually presenting a very similar picture. If we look at, for example, the current rates that we are seeing, even in take it we typically see and we are still seeing this pickup of like 1 to 4%, right, above the leverage loan market. So that should give you a pretty similar marker like what we have seen in the past.
yeah. Thank you. Okay, no more questions for the time being, but we'll leave it a little bit of time. So if you are in the process of typing up the question, we want, okay, we have another one. Great. Um, any bad experience and or bad judgment with Hamilton Lane regarding your private credit loans? Have you had any?
I would
I think we
say
can
that
touch maybe on your default rate, I guess your track record.
yeah, I would say that I mean for being 20 plus year in the business, in the credit business, it will always have the case where you run into some of the issues that need restructuring or need a workout situation. So I would say on the broader track record for us, I think it's sort of 0.1% default rate on a because our business actually does like senior direct lending to junior to mass, the whole range. Even though in this case we're talking about just the senior secured side of things. So overall, of course, we have had the I wouldn't say it's a bad judgment. It usually is the case that when you are underwriting a business and then there's usually like base case, stress downward stress case and then there's an upside case, right? Upside case usually is not a major concern for lenders because we're very bearish people try to look at the downside scenario. So for example, I would say through COVID, if you were invested into more the F&B type of business, we don't have a lot of that, but we obviously have some businesses that are more impacted by COVID. It was a more there was temporary stress in the system, right? It's a situation or scenario that was novel. It's not been seen before. If it was a business that was depending on like footfall or invest consumer patterns during that period of time, I would say a lot of companies were more stressed. However, I will also go on to say that during such a situation, actually private credit does better than broadly syndicated loans because sometimes you can see that a situation can be temporary. Like in the case of COVID, we albeit we don't know how long that COVID is going to last, but we know that COVID will not last forever. So we have the opportunity to actually work on restructuring the loan a little bit, maybe reducing the regular payments, pushing it over a longer period of repayment as well, so that the company can retain cash and continue to survive, so that eventually you can actually get your loan back. So it's incredibly important that as lenders, we try to anticipate all types of scenario, but we cannot anticipate every type of scenario as well. So I would say that in the case of COVID, we did experience some stress situations, but we actually didn't have a default case because we are able to work out on the cash flow, helping our companies to ride out the situation better as well.
Great, thank you. A few more questions, which is great. So, does Hamilton Lane and Statuary report or disclose to private credit fund subscribers of the top loans in the portfolio? Please provide example of metrics provided in such reports, if any. Yes. So, when you are a verified accredited investor with us, if you want to see, you will actually find private credit in the app, but until you're a verified accredited investor, you won't see all the details. But when you are a verified accredited investor, you will find a fact sheet, which will provide you all the details. So this will include the top 10 loans essentially in the portfolio. And I think actually also just to add to the previous question, I think it's important to remember that when you do invest in private credit with us or with Hamilton Lane, you're not you're investing in a fund or a portfolio with many investments. So the diversification there is key. As Corinne mentioned, there can be unknown unknowns or black swan events or something that can trigger a default. Because it's senior secured, they will get majority of that back, but there can be situations that are just unforeseen. But again, if you are investing in a fund with many investments or loans, then the impact it's going to have on your investment is not necessarily gigantic. But yes, so when you are verified accredited investor with Stashaway, we will provide you with a fact sheet, which will have all the details that you will need to invest. Anything to add there? No, I think that's good.
No,
Okay. Yeah, sorry, go ahead, Corinne.
yeah, I mean, I see the Q&A box, the second question on leverage. So private credit funds tend to have some leverage. I think it's relatively common. I think at Hamilton Lane, we have some modest leverage in our strategy as well. So I think it makes sense for an evergreen fund, and usually it's used for this case because a portfolio can receive inflows every single month, and at the same time, the loans are being invested, right? Every periodically. However, they may not match nicely to each other, right? It doesn't mean that this loan came in like and is into this investment. So in a case of leverage at a vehicle level, what it really means is that we have a credit line that enables us to say, oh, okay, that is actually this expected inflow. We can actually lend to this borrower first before this cash actually hits the account. So there's a bit of this efficient portfolio management that's actually really essential in the smooth running of a private credit evergreen portfolio. So as a result, we do have some modest level of leverage. Usually it's around 10%. We can go up to 30%, but it's again not in the grand scheme of things, we consider a highly leverage. Um, as as well at the same time, if you look at the quality of a loan in terms of being high, senior secured, etc., this is something that we're actually relatively, this is a level of leverage we're relatively comfortable with.
Yeah, and I just put up again the contact details for Vincent, Janelle, and myself. So any questions you have around the fund specifically that we do offer through Stashaway, reach out to us. We will help you verify your accredited investor status if you're not already an accredited investor. If you are, then we will share the fact sheet and more details with you. Okay, another question. What risks, worst case scenarios should investors expect when they partake in private credit? Guess it depends.
Yeah, I think with downside risk is all we think about when we are credit investors, right? I mean, you don't go around, thinking about the upside as credit investors, but you want to have a sleep well at night kind of portfolio. I think the worst case scenarios is that you have a very concentrated portfolio in some kind of sectors. All right. I think there are, in the market, there are also some of them very highly concentrated in some kind of sectors, and all of a sudden that sector falls into trouble. So, avoid making very concentrated bets in a particular thematic. I think also avoid excessive leverage. I think to the other question, leverage can cut both ways. It really can help you enhance the return, or it can actually have exacerbate any downside as well. And thirdly, I would say that investors should um try to I would say look at like diversification in every sense of the word, right? So not just like the sector is diversified. Who are you doing? Like the type of who are you actually who is the counterparty, right? So if it's like a particular general partner, are there multiple general partners that you're working with? And if one of them seems to be in trouble or seems to be not being able to originate loans as well as before, then you should be have the flexibility to have other partners that you're working or general partners you're working with as well. The downside scenario is really quite limited, generally speaking. If you are focused on making high quality loans, you're focused on diversification, you're focused on not taking very complex structures or a lot of pay in kind deferrals, ARR. I think there's also a common thing that's been happening in private credit is people taking like a annualized revenue type of loans, which is more focused on loans that are not actual based on free cash flow, but actually based on some kind of like metric of recurring revenue. That's also not extremely reliable as well because you can only be paid back your loan from cash flow, right? Not from promises of revenue. So as long as you're taking care of these metrics, I think should be relatively benign in terms of downside.
Okay. Last question. Do the credit investments that Hamilton Lane make contain equity kickers to enhance returns?
If in the obviously if you're looking at some kind of portfolios that Hampton is managing that is like mezzanine or junior debt and like have different type of structures, more opportunistic, potentially we will have that, and that will be for a different type of risk profile. But if you're talking about a senior credit, senior secure credit, kind of like strategy, no, that's not something that will be the source of returns. The source of returns are mainly this um, try to make loans that are regular cash pay and regularly hold it to maturity or until the point that it might be refinanced and get your money back. So it's really very plain vanilla kind of strategy that we are trying to execute in a senior credit strategy.
Right? Think that was all the questions. Then we finished right on time. Thank you so much, Corinne. And maybe just to quickly close, for those of you who may have joined a little bit later, we spoke about SRS as well, and that's because in the coming days you will be able to create a private credit portfolio and fund it with your SRS funds. So keep an eye out. It will land in the app in the coming days. The team's working very hard to release this. So we're very, very, very excited about that. Look out for our emails where we will let you know once it's fully live. There will also be, a nice launch promotion for you. So keep an eye out for all the emails coming in the coming days. Okay, thank you so much, Corinne. Really, really appreciate your time, and thanks
Thank
everyone
you.
for
Thank
joining us.
you.
Have a nice evening.